Hello, everybody. We've got a special edition here at On Track Wealth Management. Today, I am Jeremy Whidden, and I've got my normal partner here, Jimmy Burns.
Hello, everybody.
And our special guest today is Am Patel. He is our 2023 intern. And so we are really, really happy to have him here and hope that you've learned a lot over the course of the summer.
Yeah, I definitely have. Thanks for having me. It's been an enriching experience, of course, and I'm super excited to discuss about bonds today.
Absolutely, we sure are. So um, there's a picture of the three of us. Give us a little background about what it is that where you're studying, what your intentions are during college and beyond college.
Right, so right now I go to the Ross School of Business at the University of Michigan. I'm getting a bachelor's of business administration with an emphasis in finance. So right now I'm looking forward to, outside of college, maybe joining a career in investment banking. Obviously, that's subject to change, but definitely somewhere in finance. Thus, obviously, me being here and obviously trying to find a world of wealth management and a world of finance. And yeah, so right now, definitely looking forward to investment banking.
Well, it's been a real pleasure having you here this summer, and we've certainly been able to have some great conversations and great discussions, and I think it's been enriching for all of us.
Absolutely, yeah.
So we chose the subject of bonds because bonds, as we kind of say, they've become interesting recently, and because of that interest, from a portfolio construction, from a client perspective, and from a markets perspective, we really thought that it was important to deep dive into this. And of course, that goes contrary to what a lot of young people might think. Bonds, in fact, are something that are oftentimes not discussed among your cohort, your age group. Am I right in saying that?
Yeah, absolutely. I think when it comes to like kind of young investors, they always really think about stocks and maybe like crypto and stuff like that. And I think when it comes to bonds, it's more boring because of the fact that it's kind of like a low risk and a low kind of yielding financial instrument. But definitely being here and learning more about bonds, I've seen the diversity of bonds and definitely the kind of think market effects that can have on bonds. And I think right now it's a great time to be learning about bonds because of the fact that it's so versatile and it's so changing, for sure. Yeah.
Good.
So maybe bonds aren't always for your parents.
Right.
Right.
It's not just for the people driving Buicks. Oh, no, nothing against the people who are driving Buicks. Those are pretty cool cars. But I do think that this has been really we've kind of turned it upside down a little bit for you, I think, this summer, and it's been really, really interesting and good. So, just a framework of the discussion today, we're going to be talking a little bit, kind of in three different parts here. Alm's going to be asking us some questions. We're going to have a nice discussion with one another. We're going to keep it around inflation and yield curve to begin with, and then we're going to get into the differences between corporates and treasuries and high yield bonds and municipal bonds.
Mhm.
And then lastly, we'll kind of bring it all home with the portfolio construction. What role do bonds play there, and who are they for?
Right. Yeah.
Great. So have at it. Give us your
Ask
best.
away.
Yeah, so I think one of the biggest questions right now I have is with the recent hikes in interest rates, including the last one by the Fed, it's looking more and more so like kind of getting the peak of interest rates, and maybe we're looking forward to interest rates declining soon. So, with that being said, would you say right now is the most ideal time to utilize the bond market, and is this really the ending of the rising of interest rates?
It's a great question. I wish we knew the answer. Sometimes we will look forward into like the Fed futures market to try to see what the market is predicting as far as are they done hiking. The Federal Reserve, they've got the notes that come out from their meetings as far as what their projections are for future rate increases. Right now, it looks like there still is another rate hike on the table for the next meeting, but I definitely think that most prognosticators would say that we are closer to the end than we are to the beginning of the rate hiking cycle that started last year.
Yeah, agreed. I mean, we're definitely there. I mean, if we're not there yet, we're close to being there, right?
Right.
And so we've got a couple of slides that we're kind of interspersing into this conversation. We thought this one was relevant because you look back over the last 20, 25 years, here's what the Fed funds rates have looked like in black. You see, it was I mean, clearly at the beginning of the first decade in the 2000s here was a lot different than the last decade. But yeah, we're entering a new time here. But again, what's new is old.
Right.
I think is the point.
Yeah.
People pretend like we haven't seen this. We haven't seen this in a generation.
Right.
But in fact, what we're seeing is a reversal to what was normal for many, many decades.
Right. So if you were to start on the left side of this graph back in 1999, you could see that's where the economy was still doing very well. You were starting to get the implementation of the internet in a much more meaningful way, and then also we get the dot-com bubble. So what you can see here in the trend of the rates is, as we've had economic struggles, the Federal Reserve has stepped in and cut interest rates to try to help stimulate the economy. So you see in that 2001 period, boom, we see a steep decline in interest rates to try to stimulate economic activity. Right. That worked, things stabilized, we start raising back to normal, and then bang, 2008 happens, and we have this great crisis. And so what do we do with the Federal Reserve? So the Fed has a very large impact on the fixed income market as a whole. They step in 2008, we cut rates down to zero. I don't think the intention was ever to keep it as low as it was for as long as they did, but they tried to start raising rates in 2015, and that's what we had, what they called the taper tantrum. We started raising rates, the market wasn't ready for it. And so you can see there in 2019, we started cutting rates again precipitously. And then what we saw last year was unprecedented in the velocity of the rate hikes. Last year having 8 hikes in 2022. So as you're looking at the projections, the market and the Federal Reserve meeting minutes are all calling for rate cuts over the next year or two.
Yeah. So I did skip a slide here and wanted to just note that the market in your question. Let me go back to that. Your question was, is now the right time to get into bonds? And of course, we were just having a discussion about this previously, and it's all relative, isn't it?
Absolutely.
It's all relative. But when you're at the top of this rate cycle, this hiking cycle, your real questions are, do you want to add duration to your bonds and take advantage of it? Do you see an opportunity for cuts being a tailwind in a bond fund and turning that into a motivator for getting into bonds? I think the answer is yes on all of those fronts. And also just from a pure fixed income perspective, yes, it's interesting because now your rates on the short end of the curve are 5% plus.
Right. And so what isn't captured here, but has been part of the discussion with you over the internship here is the maybe it's intuitive for some, but not for all, but that there is a inverse relationship between interest rates and bond prices. Yeah. So as the Federal Reserve has been hiking interest rates, the bond prices have come under pressure, right? Mm-hmm. And now when you do start to, so answering your question more specifically, is this a good time to start utilizing the bond market? I agree with Jeremy. The answer is much more likely yes, mm-hmm. because if we are at the end of the rate hiking cycle and we are going to look for cuts in the near future, well, as there's an inverse relationship, as bond yields go down, the bond prices would be going up. So there is an opportunity for more return in the fixed income market than what we saw for that zero interest rate policy that lasted for the better part of a decade.
Right. Yeah. So we've got the yield curve here, and I know that one of the things we've discussed is it's inverted, right? Yeah. And mm-hmm. you've asked what does that mean, right? Yeah. What does that mean? Well, it means that it's not normal,
right?
Number one, because right. It's not normally inverted, right? You normally get more yield at the longer ends of the curve, meaning further out in years, right. than you do at this beginning end of the curve. So that it's unusual. Number one, it's indicative of a likely recession. We keep talking about this recession right. that doesn't seem to ever maybe come to fruition.
Right.
It may or may not. The soft landing concept seems more viable today than it did certainly 6, 10, 12 months ago.
Without question.
Right. So if I'm in the market right now and I'm looking to invest in the markets and but I want to add some some ballast to my portfolio. Bonds are a great way to do that, especially now.
Right.
Absolutely.
Especially now. And so if you're taking advantage of the short end of the curve, great, right? But let's say you're taking, again, if you're looking at this beyond the next year, what does it look for you then, Jimmy? I mean, what do you see? What do you see in terms of adding bonds that are longer, intermediate term to longer term? What's your opinion?
So I think it's a really important question, because we know that the inverted yield curve does not stay inverted for a very long period of time. So this has been an opportunistic time to take advantage of the front end. I think it's interesting if you look at the 10-year mark. So if you start on the x-axis here and you work your way across and you find that 10-year number, as of July 31st, that 10-year number was at 4%. If you drop down and you look at the end of 2021, you were only getting 1.5%.
Right.
If you could lock in a 4% rate of return right now from a U.S. Treasury, if the Federal Reserve does start cutting rates, that's going to provide you a real meaningful yield in your portfolio, meaning above inflation rate. So if they believe that the long-term inflation rate is going to be 2, and you could lock in a 4% rate of return right now, that's going to look pretty good for you over the next decade.
Right. Absolutely. And I guess maybe another question I would have is, I mean, moving into like retirement and stuff like that, you're trying to kind of lock in longer term bonds as a way of providing income off of that interest. But obviously looking at it right now, you can see that the shorter term bonds provide more of a yield and provide more of an interest rate for you. So how would that maybe look like for someone who is maybe retiring or near retirement, where you can lock in a longer maturity, but for a shorter interest rate, rather than maybe investing in a 1-year or 2-year bond and getting a higher interest rate? How would that look like, maybe in terms of someone who's going into retirement?
So it's a great question.
Yeah.
Bonds, they're not as boring as what they appear on the surface. And one of the risks that is involved with fixed income investing is reinvestment risk. So yes, you could go on the shorter end of the curve, but what happens if and when this yield curve normalizes and you've been buying these shorter term bonds, and all of a sudden that 4% yield you could get at 10 years right now no longer exists, and it's down to something like, call it 3%.
Yeah.
All of a sudden now you're going to be kicking yourself that you didn't lock in a 10-year 4% rate of return, which you can't get too caught up in the short run, especially for those that are entering retirement or just into retirement, where there is an income need from the portfolio, where you're living off of your asset base. It's very important to keep short, mid, and long-term goals in mind when you're constructing the portfolio. So as we will eventually wrap this up with the portfolio construction component, you think about like the 60-40 portfolio has been so well discussed in the financial media. That 40% component of fixed income, if you're able to get a 4% rate of return right now, sometimes it's like the devil you know is better than the devil you don't.
Right.
And so there is some component of now is probably a better time than, like to Jeremy's point, in the last 6 to 12 months, where the short end was absolutely the place to be. Now we're trying to look where, okay, that's been a nice place to be, but we might be in the transition point of it is time to start locking in some duration and let me get some of that, so I reduce my reinvestment rate risk.
Right. Well, and that jives really well with what the professional bond management firms and money managers are saying, right? We talk to these folks, they are saying that the intermediate term, that 5 to 7, maybe even pushing it out to 9 and 10 years, is really a nice sweet spot right now, because again, you chase that yield 5.5% on the 3-month, that looks and sounds great, but it's only 3 months.
Right.
And that reinvestment risk is there. Yes, you go out to 10 years, it's only 4%, but that 4% could look really good. And again, where was it before? The chart shows you. It was a 1.5, right? I mean, we were talking about 1.5%, and not even any,
not even keeping up with inflation.
Not even 2% inflation. Right.
Exactly.
So things have changed, and they continue to change. But I mean, we think lengthening out the curve.
Right.
One of the best ways to do it is a bond ladder. Because we just, nobody can predict exactly. So a bond ladder is going to enable you to participate at shorter ends of the curve,
right?
Middle ends of the curve, the intermediate term, and if you want to, pushing it out even past 10 years.
Well, it's, we talk about diversification all the time. I think everybody understands the importance of diversification, not having all of your eggs in one basket. I think this is sort of the time where you got to start saying, what does my fixed income bucket look like?
Right.
So I think at this point we'll probably bored everybody to death over the inflationary risks. Certainly this is something that's talked about a lot. So let's transition to the next section here.
Right. So I guess maybe the next section I would talk about is kind of like the difference between corporate and government bonds. I know there's still bonds that still produce pretty good interest rates, but kind of want to know what's the difference between maybe corporate bonds and then maybe different types of government bonds like municipal and treasury bonds. What kind of is a different yield and kind of like the different benefits that you get from having these different types of bonds.
Yeah, so again, you got to start peeling back the onion on the fixed income space as a whole, and you do find different bonds. There are corporate bonds, treasuries, your local municipalities. One of the most important things to consider up front, the difference of corporate bonds and the taxation of corporate bonds differs from municipal bonds and it differs from treasuries. So what you see here on the left side of the graph we're looking at here, all of a sudden you're starting to look at a tax equivalent yield because municipal bonds are free of income tax from the federal government. It can also be free of tax from the state if you're buying a bond in the state which you live. Now you've got a bond that's paying you interest that is not taxed on your state return or on your federal return. And so what you're seeing here in the muni tax equivalent and the treasury yield curve is it's starting to look pretty attractive for those that have non-retirement money to maybe start increasing their allocation to municipal bonds to increase that tax equivalent yield.
Right.
That's a big point, isn't it? And it also goes to that big picture question that we always ask people when they're looking to invest is, what is your risk temperament? And so this comes into play when it comes to selecting treasuries, corporates, high yield, or municipal, right? And we've talked about that. And as you know, the treasuries are sort of the gold standard in terms of credit worthiness, right?
Yeah.
We had that little scare here at the beginning of the summer with the debt ceiling crisis.
Right, yeah.
Outside of that, though, right, they always pay back their principal, don't they?
Exactly, yeah. I definitely do agree with that. And I guess thinking more into like municipal and treasury bonds, they do provide maybe more of like a tax benefit as opposed to like corporate bonds. But I know that if you kind of are investing through like a retirement account or stuff like that, you kind of don't like look for that tax kind of equivalent yield curve. So how would you kind of balance the fact that maybe some people are investing through a retirement account, some people are using non-retirement accounts? How would you maybe balance the risk?
Great question.
Yeah, it's a great question. So we talk a lot with our clients about the importance of asset location. So I think most people understand asset allocation, again, like that, how much to stocks, how much to bonds, but what account types do you have and what types of investments should go in which types of accounts?
Yeah.
Right. So to your point, there's no sense in owning a bond that is kicking out tax-free yield in a tax-deferred account. So if you have an IRA or a 401k, it's not the place to be buying a municipal bond.
Right. Yeah.
Right. So it's very important that investors are paying attention to, yes, the tax equivalent yield is great, but it doesn't matter if you're talking about a tax deferred account.
Exactly.
So it's really important that you understand the types of accounts that you have and the types of investments that you want to allocate to and which buckets should they fall into.
Right.
Yeah, well said. Well said. I mean, it's a big difference. So we've got this slide up on the screen. I just wanted to point out a couple of things here that are interesting too. I mentioned before the risk profiles, right?
Right.
And so we talk about treasuries being sort of the gold standard, right? And then you get into the next level of credit worthiness. You take a look at corporate versus municipal environments, right? And at the end of the day, what we're seeing in the lower right-hand side of this is the muni and corporate default rates. So in blue, you see the corporate default rates, the municipal default rates, extraordinarily low. A lot of people don't realize this, how low those are. When you're AAA rated, that means, AAA to all the way to BAA, you're right there. You're in a very, very safe zone, whether you're corporate or whether you're municipals.
Yeah.
It starts to diverge a little bit between corporates and municipal bonds in that so-called junk or high yield space, right?
Right.
And you get certainly the corporate space is a little bit more risky at that point but the question is the yield there to entice people in?
Right.
Yeah.
Right.
Is the yield there to entice people in? But I think the important thing to walk away from this is that bonds are generally safe as long as you're buying it from a highly rated, very, very well situated and liquid organization.
I think I gotta be honest. The chart struck me the relative safety of the municipal bonds relative to the corporates,
Right.
and how much lower the default rate is. You go all the way across that bottom right graph, AAA's all the way down to the junk rated bonds. The corporate bonds have a substantially higher default rate at every measurement of credit worthiness from the credit ratings agencies.
Yeah, they absolutely do.
Absolutely. And I think kind of what strikes me as interesting is the top right portion of this. Kind of want to ask, like, how does the federal government budget kind of differ from municipalities in terms of that graph we see right there?
That's a great question, and I think that ties into the default rates very nicely because the federal government can and will partake in what they call deficit spending.
Right.
And and that can be very stimulative to the economy. It seems a little counterintuitive that they can run a budget that has a deficit, but that's what you see with the federal debt. And you see the state and local municipalities, they don't have the same benefit of being able to turn on a printing machine and print more dollars to
it's against their constitution.
Float in circulation, whereas the local municipalities have to balance their budget.
Exactly.
And if they don't, then there needs to be some sort of offset for, if we operate at a deficit, well, then we need to raise taxes in some form or fashion. But the federal government is able to run a much longer leash from a deficit spending perspective. So I think that absolutely ties into why you would understand the bottom right making more sense when you think about the way that those budgets work.
Right. And does it ever kind of concern you about maybe the government keep on, rising the debt ceiling and stuff like that to a point where, maybe in terms of government bonds, they won't default because the government will keep on raising the debt ceiling, but maybe to a point where like you kind of get concerned, maybe the next time they won't, maybe they have to start cutting back and stuff.
I think so we are certainly not economists here, but we've all studied economics at some point in time, and I think what is cause for more concern is the percentage of debt relative to GDP starts to become a little bit more concerning. Again, deficit spending can and has historically been a very stimulative tool for the Federal Reserve and for the government to operate with. But it is certainly something worth keeping an eye on. As you can see that the graph in the top right, that a percentage of GDP of the deficit spending has been increasing quite a bit, up to 97% at the end of 22. So it's not like a red alarm at this point, but it's certainly something that you have to keep an eye on.
I think it feels like a red alarm sometimes when the media frenzy around it and the political football gets passed around in a massive way, like it was here last quarter with the debt ceiling crisis. It feels like it's going to crumble, but the reality is it has not, and it probably will not ever crumble. But I agree with what Jimmy's saying here, is that deficit spending piece. What does that mean for the next financial crisis that we face? It probably means that the Fed is on an island by themselves to cut interest rates, but from a stimulative perspective, from a fiscal perspective, the federal government doesn't have a lot of dry powder to work with when we're already overspent. So it has a bunch of different implications in my book.
Yep.
Absolutely. Yeah. And I mean, talking about corporate and municipal bonds, but I think kind of like the elephant in the room, how about, high yield bonds, and how do they kind of tie in here with, the fact that kind of with the default rates and maybe them being called junk bonds, but like maybe them being more appealing in today's type of markets.
Yeah, it's a great question. I think there's probably a chart that we can show that will Here we go. Perfect. High yield bonds. So, what's really interesting when you look at the box with the blue, the gray, and the black, the default rate, the long-term average default rate for corporate high yield bonds is just over 3.5%. And as at the end of July, we're running a decent amount below the historical average. So what does that mean? That means that not that many companies who are issuing debt are actually going broke.
Right. Yeah.
Which is a good thing for investors who are willing to take more risk in their fixed income portfolio. You can go get a little bit more return and a little bit more yield in the portfolio.
Yeah.
Taking more risk, yet the risk that you're taking at this point has been paid off, because the first concern for you is, am I going to get my money back? And the answer, broadly speaking, has been yes, because the default rates are just barely above 2.7%.
Yeah.
So very few companies outside of like the Silicon Valley Bank debacle we had this year, very few companies are you seeing actually file for bankruptcy at this point.
Yeah, it's a great point. I mean, that low default rate in some ways makes high yield attractive. Right. And in other ways, because of a yield perspective and the spreads between it and higher credit rated bonds, it neuters it, right? This is high yield bonds are interesting because they are not for everybody.
Right.
Number one, they are definitely a higher risk environment, but they can produce equity-like returns or better.
Absolutely. I mean, and you look at like the correlation when you're thinking about, and we'll pivot to talking about portfolio construction here shortly, but when you start to think about looking at what role are bonds supposed to play in the portfolio, those high yield bonds can have a very high correlation to stocks, because to your point, you can get stock-like returns from a fixed income investment.
No doubt.
So it's just a matter of the timing of that and making sure you're getting enough juice for the squeeze of taking that additional risk. Is it worth it?
Right.
Yep.
And you talk about timing. How would you really, go about like timing the perfect time? Not maybe the perfect time, but most ideal time to target the high yield bond. Is it when the default rates are low, or is it maybe when kind of there's more of a difference between regular bonds and high yield bonds?
I always like your example, Jimmy, on this one. I mean, I've heard you talk about this before. You go back to the financial crisis, 2008, 2009.
Yep.
Tell us a little bit about that story again.
Yeah, so I mean, you start to think about when is the best time to get the most juice out of the squeeze of taking the additional risk. Right. It's typically at the very end of a recession. Now, the difficult part about that, as we know, is timing. The beginning and end of a recession is very difficult, particularly from an economics perspective, because the data that you're looking at from the economy is always lagging. And the stock market is a very forward-looking mechanism.
Right.
Economic data is very much lagging data, right? So when you're looking at the 08, 09, the crisis there, and the wide gray bar there noting the recession, the ideal time would have been to buy it at the very end, at the tail end of 2008, beginning of 2009, because the spread between those higher risk, high yield bonds and the higher quality bonds had blown out to a much higher number. So the more that those spreads blow out, as you might hear discussed, that's the most opportune time to start getting corporates, or the corporations that are issuing debt are having to issue them at much higher rates, because there's in theory a lot more risk given the economic uncertainties.
Right.
If you can buy them at a much higher yield, again going back to the fundamental component of fixed income being that there's an inverse relationship with bond prices and the bond yield.
Right. Yeah.
As those yields are really high, and eventually we're going to have them cut to stimulate economic activity, if you can lock in the really high interest rates, and then we start cutting from that point, well, you're getting all the price appreciation for those the rate cuts that come into play. So the ideal time, if you could time it, would be just on the heels of a recession.
Right.
Yeah. Which I mean, it leads me to another piece, which is to say, when we had a historical situation over the last 10, 15, call it 10 years, where there wasn't a much yield to be had in the marketplace. So I think it was perhaps tempting for people to get into high yield at that point. And I think the next slide actually kind of shows a little bit about some of that the volatility within the bond space, right? And whether or not when there's a situation over the last 10 years where there was very little yield to be had, investors may have been going with a core and satellite kind of construction in their portfolios, right? Where they say, yeah, okay, I need to have some bonds in my portfolio, but I want to juice it a little bit, amplify it a little bit, so I go high yield, right? And I think that's another space where high yield has been played and could continue to be played in today's world, because if you're highly diversified within the high yield space, chances of losing all your money is very little. If you're invested in, if you're just a bond holder on one singular bond, well, if that one goes belly up, then you're done, right?
Right.
But if you're highly diversified, again, it goes back to diversification in bonds and in stocks. You can ride out a lot of different storms that may or may not occur.
I think this graph is really interesting. We look at a similar one for stocks, and we've done videos on this in the past. A very similar chart for the S&P 500, but what jumps out at me here is the lack of volatility in bonds. We had a lot last year with this like unprecedented velocity of raising rates 8 times in 2022, and so you see a big drop there in the last year. But if you scrub that out, you look at this, the gray bars are the total return for the year. You've got 42 out of 47 years going back to 1976 here where you have positive returns. So you're talking almost 90%, just short of 90% of the time that we're looking at here, you have positive returns, and you have a 3.3% maximum or average maximum decline in any one calendar year. Not a whole lot of drop. I mean, we've seen days in the stock market where you get over a 3% drop in one of the NASDAQ or the Dow or the S&P 500 might drop 3% in one day.
Right.
Yeah.
Certainly in a week.
No doubt.
But you're talking about a full calendar year here, that's the average maximum decline for 47 years. That's
steady Eddie. Yeah.
This chart here, this graph here shows me bonds are boring.
Right. Yeah.
Bonds are boring, but doesn't make them unimportant, right?
Right. And I mean, talking about all these different bonds, if you kind of put them together, and you kind of blend them into an actual portfolio, maybe laddering different bonds, different types of bonds, different maturities, is a 60-40 method where 60% stocks, 40% bonds still relevant, especially because of last year? Do you think that maybe it's time to change that kind of blend, or do you think it's still a relevant kind of asset management style?
Well, I guess I would start that with, for the zero interest rate period from 2008 when we started cutting, there was that little taper tantrum around 2015, but really all the way up through 2021, there was a real argument to be made of why do I have 40% of my portfolio in bonds?
Absolutely.
Right.
But given the kick in the shins that the 60-40 portfolio took in 2022, I actually think, again, thinking back to the yield curve graphs that we looked at earlier, the 40% component of the 60-40 model makes a lot more sense today than it did 2 years ago, going as far back as 2009. You could have made a real case that why do I want to have 40% of my portfolio in bonds yielding next to nothing? But as we sit here today, and we're looking at data at the end of July of 23, I think it's making a heck of a lot more sense today than it has in the last decade plus.
Yeah, I couldn't agree more. I think when you hear people say 60-40 portfolio construction is dead, I think that was short-sighted. That's really looking at how poorly bonds performed and how they correlated pretty highly with the equities market in 2022.
Right.
And it's just not fair to take a single year and project that to how you should use an asset class.
Right.
Just not.
That's the beauty of zooming out here, right? And looking at 47
Absolutely.
years worth of data. Let's zoom out and take the big picture here. Like let's not anchor too much to the recency bias of what happened last year.
Great.
Let's use history to create some context over how much of an anomaly was 2022.
Right.
Yeah. That investor psychology is clear and present when you're saying 60-40 is dead, because that is that recency bias piece, and it's got more wheels today than it has in many years.
And I kind of want to build off of that. I get that the 60/40 is kind of more so, there's growth, but there's also more hedging going on. Maybe there's a negative correlation between the two. But I get to the point where, if you're near retiring or getting towards retirement, that could make sense. What about if you're someone maybe on the younger side, maybe like 20, 25? How would that look? Would you want to, include the same type of portfolio, or would you want to maybe go more riskier and have a more hedge?
This is a very personal question,
Right.
And because just to say that because you're young doesn't mean that you're not risk averse, right? I mean, like young and risky aren't necessarily always intertwined. From a personal perspective, right? So number one, that's the biggest thing there. Some people just can't stomach seeing the losses in the stock market, as an example. But from a technical standpoint, the answer is the younger you are, the more risk you should be taking. Taking too little risk is actually risky, riskier, and it will continue to neuter your total return over the long run. So, look, if I'm sitting here and you're a prospective client and at 20 years old, would I want you to get into 40% or 20% of your portfolio in bonds? I would not. I would not. I would want you to lean heavily into the equities, at least at a near 100%.
Right.
I think there's an interesting anecdote to add here, and that is, so we utilize Harry Markowitz as the creator of modern portfolio theory, which is trying to create the most efficient risk return profile in the portfolio. Right. What's interesting about Harry, when you start to read back and understand who he was from a mathematics perspective and building the optimal portfolios, what's interesting is he didn't actually deploy his own research in his own portfolio. He put basically did like a third of stocks, a third of bonds, and a third in cash because he didn't have the stomach to watch the markets move, that the stock market moves, take over such a large portion of his portfolio. So this is a guy who literally is the father of modern portfolio theory, which has driven so much in the portfolio construction research, and he didn't even use his own work. So again, that's to Jeremy's point, this is a very personal question, but I would agree with you. The longer term horizon that you have, historically speaking, you have been rewarded for taking risk. So it's a question that has to be answered again with zooming out and having the proper context of, well, what are the expectations and what is my risk capacity, but not only my risk capacity, but what is my tolerance for that risk? You have the capacity at a younger age to live through more of the ups and downs. But do you have the stomach for it? And that's a much more personal question.
Great add there about Harry Markowitz. And the last thing I'll insert here is that the high yield bonds, again, they act like a little bit more like an equities play than they do a traditional bond play. So, if somebody's looking to get that higher yield and they're willing to take the risk associated with that, then I think that absolutely should be part of the discussion for a portfolio construction for a younger person.
For sure. No question.
So, and related to that, we thought this was be an interesting kind of thing to anchor back to end the conversation, right? Is that your asset class returns, and this is actually based off a 60/40 model,
right?
And how it looks, and we talk about this a lot with folks because you're never going to with a 60/40. With the rarefied years like 2022, you're never going to find yourself at the top of the return list, and you're never going to find yourself at the bottom of the return list. And that is proven out here over the last 15 plus years, that you find yourself somewhere close to the middle, but you're participating in all the different asset classes.
So again, the white box here represents the asset allocation of a 60/40 portfolio. And what's interesting is when you are able to generate average returns over a long period of time, they actually turn into above average returns because the other asset classes are bouncing so much higher and so much lower. It's a unique phenomenon that you look at the white box, and if you go to the far two bars there, you see the asset allocation return, the 60-40 return from 2008 through 2022 has the fourth best rate of return annualized. However, it has one of the lowest rates of volatility, which is the far right bar there. So you're getting back to like optimizing the portfolio construction, having the fourth best annualized return, but having the third least amount of volatility has been a really good trade-off for investors. So even through a period of time where you could have made the argument that, my goodness, why would I want to own bonds in the zero interest rate environment? Right. It has still, through that entire time, produced the fourth best rate of return relative to all the other individual asset classes.
Yeah, kind of borrowing from Bogle, there's an infinite number of ways that you can invest poorly, right? And that can really, really hurt you, both in the present and in the future. And so taking a more measured approach, it does tend to pay off. Again, we are not sitting here and advocating 60-40 for everybody. It's a good example of what it takes to build out a well-diversified portfolio that does in fact include bonds.
Absolutely.
Right. And I think coming into this and before the summer, honestly, I kind of didn't understand the whole point of honestly having that risk management type of style, and I guess maybe it comes with being young or whatever, but I think definitely having a more mixed portfolio kind of focuses on growth but also capital preservation, and I think managing your risk while also trying to maximize your growth is something that definitely, as you can see in this graphic, it works out in the long run. So it's definitely something that it's not maybe short term, it might not look the best, but I think that over the long term is probably the one that builds the most.
And I remember early in our conversations this summer, when we asked you, what are most people your age looking at, because 20-year-olds are not typically our ideal client target.
Yeah.
And you said crypto and individual stocks and we immediately started talking about the risk profile associated with that. So I'm really happy that that's something that you've earned and learned this summer.
Right.
I think it's vitally important.
Yeah.
Right. Yeah. Absolutely.
Well, I've learned a lot today.
Yeah.
I have as well.
Yeah.
So thanks so much, for everything that you've done here this summer and for coming up with a fantastic list of questions for us today. So we'll wrap it up with that, folks. Thank you, everybody, for listening.
Yep. Thank you guys for having me.
Thank you.